It's Thursday. That means Traders Workshop. That means Jason and Mark, and we're going to talk about OPEX, whatever the heck that means, and some of the readings these two lads may be getting in their software. So let's get to it on the opening bell. It's been a while, boys. How are you?
I'm doing all right. How are you doing, Lex?
I'm doing well. Just the traveling fool. I've been around the world and back, I think, more or less. Yeah.
Oh, yeah. Today, I'm actually my oldest son. He's only 10, but he got, I guess I kind of got him into like a little bit of indie music, and he doesn't know it yet. But we're going to see Silver Sun Pickups later.
Oh, okay, that's cool. I don't know who that is, but sounds good.
That's why they're indie. Nobody knows them. They've actually been around for a long time, but I just noticed the market is dying. Mark, did you hit sell?
Vol or spot?
Spot.
Both.
I need a little sell
$4 billion book. He's like, I'm going to sell.
Yeah. So anyway, OPEX. Mark, I don't think you and I ever used that term in the old days. I don't think. Maybe we did and I didn't pay attention. So this week is what Jason calls OPEX. I'm guessing that means options expiration. But as we know, I'm going to let you talk. Don't worry. Options expirations happen every freaking day. So tell me about OPEX. Give me something, Jason.
Yeah, I mean, options do expire every day. But still a lot of like our mandated funds, and we notice still most of the traffic happens on that third Thursday AM expiration, options expiration on SPX. So it still does have some relevance, even though options do expire every day. And we also call it MOPEX. It's monthly option expiration. So how about that? That only happens once.
MOPEX. Okay.
I thought that's what Goldman called their customers was MOPEX.
Oh man.
Yeah, in this Twitter age, man, you can't write out all the characters. Otherwise, you monthly option expiration, you're not gonna be able to say much.
That's right. It's a good point.
MOPEX always used to mean we would get expiration food. We would get barbecue. We would get pizza. It was like a big day in the office. Like
that's a good point too.
Friday means like you're getting a good lunch. That's what it used to mean to me.
So nice. On the MOPEX or OPEX, that third, let's call it just third Friday of the month, because that's how we referred to it in the old days. SPX, and Mark, do you remember SPX settles AM on the MOPEX or no? I can't remember now.
Yep.
Yeah. It does? So it's the opening print on Friday. Is that right?
But they'll have both an AM and a PM now, I believe. So there's the AM that's like the big SPX, that's like the standard AM cash settled. And then they have the daily that'll expire at 4:15 on Friday.
Okay.
And it's even different symbols now.
SPX. Yeah, so SPX, plain SPX is the morning AM version. SPXW is the PM version, right?
Right. Mm-hmm.
Okay, cool. So is this super important to you, Jason? Tell us a little bit about it. If we have to share a screen, let us know.
Yeah, you can. I mean, you don't have to share the screen yet, but essentially a lot of the option positioning, a lot of the collars on the big institutional long only portfolios, they appear every month. So pretty much in March, you see a roll from March options into April, like all these institutional collars start coming on maybe a little bit after March expiration or before. And this happens every month. And then there's annual ones, there's quarterly ones. And so March in particular, because it's a quarter month, we'll get some quarterly flows. I mean, some of them happen at the end of the actual quarter, but there's still more liquidity in the AM MOPEX. And then and plus you have the monthly flows from February. So a lot of people, I guess, call this quad witching, but that's because of the futures options, right? Options expiration. So this usually has a lot of expiring contracts. I think a bigger deal is made of it than really needs to be. And there's a lot of uncertainty when people just say, when they justify a market move, just say quad witching, that's what it was, and have no idea what they have no idea like just how that actually impacted the market or how that impacted dealer positioning at all.
Got it. Okay.
And it makes sense,
that's
right,
why,
that all this flow is
share a
traded at
little
monthly
bit of the
expiration.
show,
It's
but-
by far the most liquid, and always is whenever they get listed. Like, you have better spreads, like even in SPY, right? Like, you're 5 cents wide in the weeklies around it, but you're penny wide in the monthlies. Like, there's just more volume and liquidity there, and it totally makes. If I had billions of dollars that I had to move, I would certainly do it on that calendar, and I think that's a self-perpetuating truth.
Yeah. Okay. So, what are you seeing, Jason, on this one? Anything unusual stick out to you, or not?
Well, I mean, so one thing that Mark said that I'll concede to Mark, because everything that Mark says, I always keep in mind, because he's been there and he studies this stuff way more in depth than I could even possibly, being that he has in experience. Dealer Vega matters, but it doesn't matter as much as I kind of thought it did because of zero DTE options. We see like a lot of hedging on zero DTE. You can bring up the thing if you want. I could talk over it.
Okay.
But because of zero DTE options, we're seeing a lot of customer option sales net ever since the dealers were positive Vega.
Okay. So you want to see this chart? Can we bring that up?
Sure. We can see this chart.
All right. Let's bring
the thing that's been driving the market up has been this positive Vanna, as I'm scrolling down here. And it's been driving the market up for quite a while. And this is like the current dealer positioning overall.
Okay.
And what I see is a lot of the aggregate Vanna that we have here. So it's like about, 30 billion. When I take out, this is when I took out the March expirations, it was 30 billion.
Right.
And now when I include it, now it's a lot less. So the market I was projecting would drop going into March OPEX.
Okay.
And then when I see it dropping today, I was like, oh, well, look at this.
Okay. So
we're a little late, so I'm sorry, but
that's okay. So I'm not connecting on this. I'm not understanding this. This is a chart of Vanna, right?
Yeah. Cumulative Vanna across all expirations, across all strikes.
Okay. Now tell me the X and Y axis and why there's a dip before we get to that I guess it's the at the money axis there.
This one right here.
Yeah. Why is there a dip there? And then what's the upside mean and yada, yada, yada. Tell us what that means.
So
give it to me in layman's terms.
So again, we're going to go back to basics. Vanna is kind of has like a dual definition. It could either mean the movement in Vega with respect to, or the movement in Delta with respect to implied volatility, or it could be the movement in Vega with respect to a move in the underlying.
Okay.
Now with dealer Vega, it does matter. It kind of hurts a little bit, but if the underlying keeps going up, this green section right here is going to add to the dealer Vega. So it's positive Vega. They get more and more and more positive as they pass these strikes.
Okay.
This negative, they would drop Vega. So this is the cumulative curve across here of what the total Vanna would be as the market goes up or down. So like, let's say right here, you would say that dealers would reduce 9 billion in notional if we go down to 47.25.
Okay.
In our white paper, something that we noticed is the bull markets really like when Vanna is maximized. Like that's when a bull market is sustained. When you're in a bear market and Vanna gets maximized, then you see it's saying like 1 or 2 months later, there'll be a turning point. Same is true going the other way. Like if it was maximized and then it starts drifting off like it is here, it would be maximized here.
Yeah.
Then it starts getting a little shaky.
Okay, let me ask you a question. So that part to the right of the graph here, that's positive, the steep sloping upward side of that. Is that saying that dealers are long Vanna or not?
Well, dealers are long Vanna because the total Vana, like if you add up every single one of these bars,
Yep.
the total Vana will be about 31 billion.
Okay, so that means that they're long Vana, so that when implied volatility goes up on that side of the curve, they're getting longer deltas or not?
No. Okay, so if implied volatility is going up, then this Vana, for every point of implied volatility going up, Vana will be it'll be increasing their Vegas. You would be going down for, like, the market would want to go down.
Okay.
Mm-hmm. So if the market is good, like implied volatility typically kind of declines. You see like contango on the and this is it's measured in a fixed price vol way. Right. So it's every single option's volatility and Vana exposure independently. We can actually see that over here in the summary sheet.
All right, let me make this simpler then. Let me ask a simpler question, I think. Are dealers long or short upside calls in your graph here? What is it? Which one are they?
That graph back here?
Yeah, the one that has the
dealers are long calls right now.
Okay. To the upside.
In the money calls over here are negative Vana, because as implied volatility starts going, if implied volatility starts going down, their deltas start going up. So that's what the negative Vana means.
Yeah. Okay. So there are long calls to the right of the center line. I can't see that very well, but I'm assuming that's at the money, that vertical line between the yeah. Okay. So they're long calls to the upside. They're
long calls to the downside here as well. If I go like this, because the sign crosses as you cross.
Yeah, I got it. Okay.
Yeah.
Okay. Interesting. But that's fairly typical, right, Mark? I mean, we always got bash calls to the upside, and we always had to sell puts to the downside. That's a typical setup for a dealer, I think.
That's all these collars Jason is talking about, I think, right? Like, I think a lot of these bought calls, I think your suspicion is right, that they're coming from these major hedging trades, essentially.
Yeah, they show up every month, or every quarter, or, but the thing that makes this different is because of how fast we rose from October till now.
Mm-hmm.
A lot of these calls are in the money.
Right.
So you're going to see a lot of 100 delta calls at expiration, as opposed to, closer to zero calls if we were below all those. The customer short calls.
The ones in the money that are 100 deltas, those are fully hedged though, unless we go through that strike again. So they typically, that shouldn't matter anymore
until they expire.
Right. Then they have then they disappear from this whole equation, right? Unless there's a roll. Okay.
Mm-hmm. Now you would think, but yeah, and they get rolled all the time, so you kind of see. But these, but kind of what we focus on is the Vana curve, because that shows you how the dealer's Vega is going to change based on moves in the underlying.
Mm-hmm.
So
so if we're going up, like we have been forever, it seems like, and these dealers are long out of the money calls, Vol's probably getting hit a little bit, so they're not as long as they think they are from their call deltas. Yeah.
Right.
Okay, so they're having to buy some sort of delta to offset that. Hence, maybe the reason for why we're so powerfully strong upwards all the time.
Mm-hmm.
Okay, interesting.
Yeah, and that's
sorry, go ahead.
Yeah, no, that's kind of the Vana dynamic, and but when quad witching hits, or and all these different things expire, there are impacts that are going to be felt on in all those complexes, in the futures, futures options, etc.
Let me ask this. We had in the past, I think when you were just getting into this, Jason, we originally all felt that gamma was the strongest force, and then we sort of shifted gears as we did more studies and learned a little bit more about this. And maybe it's not so much gamma that is the factor that causes movement in underlines. It might be something more along the lines of Vana or even Charm for zero DTEs, right? Is that still and Vega to some degree, but they're all kind of interrelated, I suppose. Is that still the case in your mind, or is gamma sort of taking a back seat to all this?
Oh, absolutely. So here I'm going to try to, since I don't know where Max is, but I'm going to try to share. Do you see my the white paper?
Yep.
Okay, great. That really worked. So here we're looking at this is a white paper that we released last December. We'll probably start publicizing it a lot more.
You mean this white paper right here, the one I have right with me? I read it before I go to bed every night.
So what we tried to do is we looked at vol and dealer positioning and tried to see what kind of correlations we can find between dealer Greeks and movement in the underlying. And that's kind of, so we went one by one through the Greeks, and at least the first order ones. And we saw that the delta change to SPX correlation, no surprise that is directly correlated.
Yep.
It had a pretty strong, significant, statistically significant, but this includes new positioning. It includes delta from gammas, and it also includes delta from implied volatility changes too. So Vanna, any kind of delta change from the from open until close.
Sure.
Any kind of hedging. So I mean, there's a pretty good correlation there. But when we started looking at gamma, you can see it's actually inversely correlated. And you think, what's going on here? Like, how can everybody believe that gamma was, and truthfully, if you think about it, if dealers are constantly long calls and they're constantly short puts, gamma should always be a headwind, right? Because as they're, they should be slowing down their hedging as the market's going up, but we don't see that. We see right now we are very strong positive gamma because we're in the positive call area and we're taking off like a rocket. It had nothing to do with gamma, and that's kind of feeding this inverse correlation. Now people, I think what people are doing is they're using the wrong Greek to their observed to their observations. They're using the wrong Greek to reference it.
Yeah. Okay. Makes sense. However, I'm going to give you another example. Okay. In the dumb money GME GameStop run up, is it safe to say that run up had a gamma component to it? Because the dealers were definitely short gamma to the upside because all they did was sell calls. And Vana kind of kicked in too because implied volatility went through the moon and they got really short because they were short. They had the Vana problem as well. So can gamma have a bigger impact in something like that than it does typically in an SPX macro where it's so massive? What do you think?
I honestly think, I mean, I've watched a bunch of, first of all, I haven't studied that yet and I want to. So I want to say that before I speculate, this is all speculation from what I've seen. But when that whole thing took off, I think that the biggest thing was the explosion in illiquidity, like one-sided positioning from market makers. And you saw implied volatility expand considerably before any move in the underlying took place. I do think implied volatility played a part. But gamma, I think, was also a huge part because customers were buying calls, which is not the norm. Like that's not the SPX, very liquid mandated structure. Customers were buying calls. So the dealers had a huge gamma component. And then once they crossed over each of those long calls, it got more and more expansive because they were crossing over and making all that Vanna positive. So it was almost like in the money short calls was creating like an extra boost and then an extra boost and then an extra boost.
Sure.
But now that it's kind of settled down, option volumes are still high because I think that's just kind of like now it's like the vol traders playground.
Right.
But valuations haven't changed fundamentally. It's kind of funny that the settling price is still, very high. But I think a lot of it is Vanna positioning because now when you look at Voland on like GME or something like that, typically you see now AMD. Is that one of the AMC? Is one of the
AMC was another one. Yeah.
It's way down now, so I can't really look at it. But let's see, where's GME? There it is. Oh, that's way down too. See, now it's all down, but it stayed very elevated for a long time.
Mm-hmm.
And I think it was because it was a vol traders playground. There was like a lot of volume on it
Sure.
all the time. I haven't looked at them in a while, obviously.
Yeah.
But it was interesting because the fundamentals didn't change throughout all of COVID,
right?
But yet the price stayed elevated for a very long time. It kind of punished shorts pretty bad.
Yeah, well, it did for sure. Yeah, actually, I was at a conference last week, and I had someone asked me that question about GME. So I had a multi-tiered answer for that one, including Gamma and Nirvana in the answer, and not to mention there was hedge funds in the answer as well, because if you remember, there's short hedge funds only involved there, and they got margin called on it, so they had to purchase as well. So it was like a 3-tiered kind of thing going on that just catapulted this sucker up there, man. It was crazy.
Yeah, well, and all on an underlying liquidity that was significantly lower, right? Like all this is happening above, in the derivative space, it's all above what's happening in the actual shares. And SPX options are a relatively small portion of SPX, ES, that whole complex is flow. They can be more material, but nowhere near the level that all that was happening in GME on the underlying.
Yeah,
right?
it's a bigger
the option space. It was overloaded from the hedge fund space. It was overloaded.
Right.
Just the pool that they were all playing with was just so small.
It was tiny. Yeah. And that's a good point, because the SPX complex, as you said, it's quite massive. I mean, I can't remember the notional of it, but it's huge all the way along. So it takes a big bust to move that one. Unlike something like GME. So cool.
Yeah, but even as those calls were passed, it would create additional boosts because of implied volatility.
Yep.
And it would shrink too, because implied volatility on like a 1 week option was like 150% annualized.
Right.
And that would have to go to 0 by the end of the week. So it would just keep pushing. I guess you could say it was charm, but
I think someone told me, a colleague of mine from a while back traded GME. He sold like the 800 call when, it was trading 500 for like $12 with about not much time to go. And I want to say not much time, meaning less than a couple weeks. That's amazing. 300 points out of the money. It's a $12 option.
Oh yeah. They were like
60% out of the money.
Yeah. 1,000 ball. Hello.
Both hands.
Both hands. Can you imagine?
Yeah, I think when GME was like 500, I sold a $60 put at like something like ridiculous, like $5.
Yeah.
And I'm like, this is going to reduce 90%. And it went down to like, 250 by the time my option expired. So it gave me like a scare. And I'm like, I'm not doing this again. Like,
it's insane. It's insane.
I'm not doing that again.
Very good. Good talk. Mark, what's new? Anything?
Well, we've been talking a little bit about liquidity, and like that's one of the things that I've been looking at is as the declining liquidity, how predictive that is of future variance risk premium, and sort of investigating this idea of how, variance risk premium is like a market efficiency thing. And as we've seen the market get slightly less liquid, like over the last 2 weeks, call it wider spreads. I don't know if you're seeing that too, Jason, but like significantly wider spreads. That's a confidence interval, right? That's a confidence interval on what the price of future vol is going to be. And as that confidence interval or as confidence goes down and that interval goes wider, we're going to see a lot choppier realized versus implied vols likely. That, as that measure of efficiency goes down, we're more likely to see gaps between whatever implied vol is trading at now and what we're going to realize over the next N days. So I think we've seen that in dispersion from the SIBO that's increased. Like, I think generally the market's expecting a little bit more, not sure which direction it's going to go, of course, but like less efficiently priced things right now.
Yeah, if you can share my screen again, Lex, I got Mark's dashboard up.
Okay.
I can show you this declining liquidity.
Yeah. So how do I read this? Sorry.
So this is the LIC index, which is a combination of volume, spread width, and open interest. And so in a name like SPY, volume and open interest are relatively stable. They're not the most significant part of this.
Okay.
You start looking down the tiers, volume becomes more significant because there's a lot more variance to the volume in lower tier names.
Right.
But basically, yeah, just selecting for implied vol width here, we're seeing that just get crushed. And I can.
So wait, does that mean when you say get crushed, does that mean markets tighten or does that irrelevant?
Sorry. So the score is going down, which means markets are getting wider.
I got you. Okay.
Less liquid.
Less liquid.
Yeah. So, and that's what you're seeing here. Those smaller bars to the right mean that that's less liquidity.
Correct.
Okay.
And if I actually pulled up a screen share too, I can. So that's less liquidity, and generally this is that liquidity measured versus VRP. So future realized, take the liquidity and then compare it to how much VRP we're seeing looking forward, because it's obviously VRP is backward looking because this is across issues. So each of these dots represents an issue.
Mm-hmm.
All the way at the right here, we've got SPY, that like very high average lick score, very tight VRP.
Mm-hmm.
As you have much lower liquidity, like your VRP numbers are going to be all over the board. This is where your AMCs, where it's totally underpriced vol, totally overpriced vol. I guess I did that the opposite way.
So VRP, just for people who might not know what that means, value risk premium, right?
Variance risk premium.
I'm sorry, variance, right? I mean, I said value. I'm looking at an email that said value on it. Hello. Variance risk premium. So that's the difference between implied and realized, or something else?
Yep. The positive VRP means the implied vol was higher than the realized vol.
Which we typically see, right? That's kind of the more usual case.
Correct.
Okay.
The vast majority of the time it is. And my kind of intuitive explanation for that, like if you get paid the equity risk premium because you're patient, because you can withstand volatility over time. And that's why equities realize 4 or 5% more than the risk-free rate. Like that's why you get equity risk premium. You get variance risk premium because you're bearing that kurtosis, you're bearing that short, and you're kind of compensated for being that, insurance fund, so to speak. And so most of the time it's positive. Most of the time it's significantly positive. Like average, actually, it's interesting within SPY, when the lick score is below 400, so call 400 like the median. If it's below 400, VRP and SPY is like 2.8%. If it's above 400, VRP is like 0.9%. So the higher the lick, the tighter the spreads, the more confident people are in pricing, they're right, essentially.
Yeah. So they converge, those two, the realized and implied, when they're so confident.
Correct. That it's that when markets are tight and they're pricing a 15 vol, it's going to realize a 14 vol. When markets are wide and it's pricing a 15 vol, it's more likely to realize somewhere between 17 and 11. Yeah.
Okay. So we don't have time today. We're going to wrap it up here. So let's chat about the question I get a lot. Again, as you guys know, I'm always on the freaky deaky plane going somewhere and talking. But the biggest question I get is, okay, great. Wow, you guys are geniuses. How the hell do I use this stuff to trade? So you don't have to answer now. Let's think about that over the next week and maybe come back with some ideas. And again, no investment advice, blah, 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 blah. We'll disclaim that, but that sort of
2
thing.
weeks, right?
Oh, 2 weeks. Why 2 weeks?
You're traveling. We're all traveling.
Oh, I am? I'm not traveling next week. Oh, Thursday I am traveling, but right.
If they're not traveling, then
wait, I'm going to New York City to see Mark and Jason. Oh my God. We can do one at the restaurant Mark's gonna bring us to.
Oh, Moonlight Trader View.
Yeah, the 7 p.m. session.
What was
the after-hour session?
That's right. In NYC.
You guys can drink wine. We'll all drink wine.
Can I bring wine, Mark? I don't know if I can get it on my carry-on. They're going to confiscate that at TSA.
Yeah, they won't let you take it in your carry-on.
God dang it.
That means Mark's got to drive it down from France. Gotta bring its French.
It already took the slow boat over. It just has to get driven down.
There you go. All right, good deal. Excellent stuff, boys. Good to see you. I will see you next week in New York City on Thursday. Awesome. We'll figure something out relative to this.
Yeah, that'd be good
if we can. So I think I arrive. I don't know when I arrive. Maybe 3:00. I forget. We'll figure it out. All right, good deal. You guys have a great rest of the week and weekend. And what do you say, Mark?
Happy trading.
Happy trading, everybody. Bye, guys.
See ya.
All opinions expressed by Trader Hub contributors are solely the contributors' opinions and do not reflect the opinions of Trader nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Trader nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Trader Inc. is the parent company of Trader Brokerage Inc. Trader Brokerage Inc. and Trader Inc. are separate entities with their own products and services. Securities products and services are offered through Trader Brokerage Inc. Trader Brokerage Inc. is an independent subsidiary of Trader Inc., all rights reserved, member FINRA SIPC.